Do stocks perform well when they have a high expected growth rate? In today's video, we are going to look at high-performing stocks that have high expectations for the future. We're going to look back a little bit at history and see when analysts are projecting a high growth in earnings for these companies, how do the stocks do? And again, we're going to look at times from the past to maybe give us some insight into how we can think as long-term investors today. Okay, so this chart here goes back and looks at, on the bottom, going from left to right, you have your earnings growth rate, your projected earnings growth. So these are analysts that get together, and this is a consensus growth rate that they are expecting from stocks. Okay, so over on the left, you have kind of a lower growth rate all the way up to 20, where you have a high annual growth rate expected from analysts in these stocks. And then over on the left, right, where it's going top to bottom, you have low rate of return to high rate of return going on your Y or your vertical axis. And so essentially, if you're up high, you get a high rate of return. If you're down low, you get a low rate of return. Over to the left is low earnings. Over to the right is high expected earnings. Now, what you can see with these blue dots that start to show up is it looks a bit random, but as the dots move over to the right, what you can see is they go from the top left and they start to drift down. So what does that mean? That means the left side, which is actually lower expectations from analysts, has not necessarily led to, because this is not a cause, this is just timing of when analysts have a low expectation for stocks. What we've seen is the following 12 months has had a higher rate of return. Going all the way over as we move to the right, as expectations and consensus from analysts, as they expect higher earnings from stocks, the rate of return for the next 12 months goes down. Now, that doesn't seem to make any sense. You would think as analysts expect higher earnings from stocks, they're going to be growing, therefore the stocks are going to be going up in value, which makes intuitive sense. However, the challenge becomes as analysts continue to raise expectations for these stocks, this becomes built into the price of the stock that people are paying. They are taking these growth estimates and they are projecting this out into the future and coming up with a model of what they think these stocks might be worth. And what happens is, as soon as the stocks don't hit these wildly high growth estimates, these stocks become too expensive, they start to come down in value. And so, okay, where are we now relative to some inflection points in history? Going back to the chart, you can see in the early 2008, as we recall, that was the global financial crisis. If you go back to the tech bubble, right, both of these time periods is where we had high expected growth rates, and then we got some surprises. Those growth rates started coming down, and stocks started coming down with them. And when it comes to where we are today, we have expected growth rates around 16%, which is quite high when it comes to the Magnificent Seven. So these are the 7 companies we've all heard of. They're doing a great job. They're coming out with fantastic products and solutions for us. However, the earnings estimates have gotten incredibly high, which means there are very high expectations built into the current price of the stock. Now, again, this is a chart showing the relationship between, earnings estimates, so higher earnings estimates, and a forward-looking, or what happens over the next 12 months. Now, just if we look in the past, it has not been great news. The higher the analyst estimates, the lower the next 12 months returns have been, just because it gets built in. Does that mean that the Magnificent Seven or any companies that have good expectations are going to go down in value? That's not what it means. But what it does show is that history has a trend. And the trend is the higher the expectations that get built into these companies, the higher the price goes. And the higher the price goes, the harder it is to make money, all else being equal, if you are a long-term investor. And so when you're looking at your portfolio and you're buying things based on future assumptions, keep in mind, analysts, really anybody, it has a really hard time predicting the future because it hasn't happened yet and it is totally unknown. And so when you're buying these analyst estimates and you're buying high expectations of the future, just keep this chart in mind. It hasn't always worked out. And as I always like to say, know what you own and know why you own it. I hope you found this helpful. And as always, thanks for investing your time with the Personal CFO.